Okay, we're letting a few people in. Here we go. I'm just waiting for a few more people. Just going to get the participant number up a little. Good morning, everyone. This is kind of what was a bi-weekly, now almost every third week market update that we're doing. Happy that each of you could join. We do broadcast live and then we record this and we put it on our Facebook site. So I'm very excited to share this information with you today. I want to start just by recognizing Thomas Wheaton and Francis Keenan from my office who worked very hard on these presentations. Thomas worked almost nonstop on this yesterday, and sometimes I get to the end and thank him, and so I just wanted to start at this presentation today. He's done a remarkable job. I think this is one of the more informative ones that we will have done all year. So appreciate you being here and look forward to sharing this information with you. With that, I'll just jump right into it. I'm the least technical person you know, but here we go. Hopefully you can see all of this. So yeah, this is our market update for November 10th. The October numbers are in, and I know most of us are very grateful that the election is over and we can try to move on to some form of normalcy here. But real estate continues to outperform almost every other segment of the economy, especially here locally in the city of Houston, Harris County, and the surrounding suburbs areas. And the information that I'm sharing with you today will just come out. I don't know that they've released it publicly, but they will very, very, very soon. And for the 5th month in a row, we've set records again. Every segment of the market is doing particularly well. In the middle of a pandemic, it's the middle, it's not the end. And of course, with economic uncertainty, declining oil and uncertainty into the oil market, things that have impacted the housing market in Houston, Texas before are not having the same effect that they would have in normal situations. And so I'm going to discuss in thoroughly, but headlines really sometimes dictate the mood of things. And the headlines as they come out later this week are going to be, record-breaking sales, record-breaking price per square foot, record-breaking dollar volume, inventory continues to decline, market continues to tighten, real estate continues to show resiliency, amazing economic performance in uncertain pandemic times. So, I mean, it's just, there's no way that the headline can't continue to say that sort of thing. And I've been very proud of HAR and the marketing department there of setting reasonable expectations. Some of these numbers are just unsustainable. And I mention that because these headlines, sales 30% up, people don't mind. That's the number of sales. It doesn't have anything to do necessarily with the price. But I noticed in previous economic downturns, if you say sales are off 30%, then people want to offer 30% less on the price. And there has nothing to do necessarily with the price that one offers, with the numbers of sales. As we have fewer sales, maybe later in 2021, it doesn't mean that the market's not going to tighten up. It's just, if you only have 100 widgets, you cannot sell 150 widgets. We keep talking about this. So the story has to do with supply and demand. And you've got to remember, we are comparing 2019, which was a remarkable year in sales for real estate in Houston, Texas. So it's not like we're comparing to the year after a hurricane or a year past a national recession. We're comparing to the very best year in sales that you could have experienced or that we had ever experienced in Houston, Texas. So you're comparing to the best years we've ever had, both on a monthly basis and on a year-to-date basis. And we provided all these slides, and of course they're all available to you. We'll make them available on our website at yourblp.com, or we'll email them to you. If you email us, of course, we're happy to sell it. But keep in mind, we're comparing against a record October of 2019. Then when you look at the year-to-date information, which I'll cover again, we just provided a brief synopsis of this deal. You're not only comparing versus last year, if you compare over the year to date, the numbers are remarkable. They're just remarkable that we would be up this much at this particular junction in 2020. So the headlines themselves are going to be very positive, which will continue to make the argument it's a good time to sell a house. Because sales are up, and it's a good time to buy a house because the interest rates are so low. And it has to be kind of win-win. You got to be able to leave, you have to buy for a reason. If not, we'll find the buyers go on a pause. I know of dozens and dozens of personal buyers that I'm working with that are frustrated because the inventory is so low, and maybe they're waiting for a little period of time. I mean, they would buy today if there was a house available that met their needs, but that house just isn't out there. But I do believe that we will solve that problem somewhat over time. You got to remember, why are we here? What is causing this situation? And that's what we have to continue to focus on. And while we all talk about supply, 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 it's really the opposite of that. It's lack of supply, lack of supply, lack of supply. There isn't enough housing. The demand is greater than the supply. The supply, the number of houses that are for sale, are at historic lows, and the sales are at historic highs. So keep in mind, with 30% less houses, you're selling 30% more houses. That's pretty resilient. And as I want to be clear, it's unsustainable. Some of this demand is just because a number of different things. The supply was lower for any number of reasons. People are moving. They're moving because they're unsatisfied with where they're at. Many of them, this was an article a day or two ago, 23 million people who are working remote are going to downsize. They're going to move to a cheaper house, whether they leave the Heights and go to Cinco Ranch, or whether they leave a $10,000 a month high rise at 2727 Kirby and go to a $600,000 house in Montrose. But for whatever reason, they're dissatisfied. They don't have a home office. They don't have two home offices. They don't have the ability to work from home and still homeschool 2 or 3 kids. And it's causing movement. Of course, you see it in the national news, people moving to vacation sites, Asheville, North Carolina, or, wherever one, the Hamptons, if you're super uber rich. I don't know anyone uber rich, but those areas have benefited also. Certainly, the New York cities have taken a hit, and the California, between wildfires and density, have taken a hit. We're not overly impacted by those markets in Houston, Texas. You were finding people that were living in a very expensive rental in one of these apartment complexes. They work downtown, paying $5,000 a month for a 2-bedroom unit. We're not able to use the swimming pool. We're not able to use the gymnasium. We're scared to use the elevator. The number of visitors were limited. Their contractors couldn't get in. And so instead of doing that at 2.75% interest rate, they can go buy a 600,000 square foot bungalow in the Heights. Their payment was less, and they can build equity. So you had people moving for a number of reasons. And at the same time, you had people who couldn't move. They couldn't show their house if they were both working from home, Zoom meetings going on 8-9 hours a week, kids, at the dining room table and the breakfast table and the island. Fear of COVID was reducing the inventory. So you had, the phenomenon, reduction of inventory, people not being able to even think about people coming in to look at their home, and then at the same time a number of people of wanting to get out of wherever it is they were dissatisfied. And you're seeing that in home remodelings and the demand for interior decorators and the demand for the landscaping services. Those have all been another area that have been doing particularly well, because people are not driving 2 hours a day to work, and they're being able to sit at home and look at what they like and dislike about their particular environment. So you have a number of people. And as I've mentioned the last couple of months, the average person is very concerned about the economy. They're concerned about the future. They're concerned about other Americans and people worldwide who are impacted by, very harsh economic times that are both here and are going to remain and be with us for an extended period of time until there's some form of normalcy. And you talk about any number of industries where that, airlines taking to 2024 to recover, hotels taking till 2023 to recover, restaurants taking a year or two to recover. I think we all recognize commercial real estate is going to be softer for an extended period of time. That we are going to have to prepare for, not our great economic times for even 2021. Hopefully they're more optimistic times, and hopefully, there's an end to COVID-19 and the impact on the both, economic situation of people have, and of course their personal welfare and health and well-being. But it's certainly, COVID has caused some of this scenario that we're in. It's caused reduction of demand of supply, and of course it's caused some increase in demand for those things. And there's any number of other reasons that people might be wanting to move. And like I say, the most expensive houses really have not fared well in any market. I mean, people who would have typically bought up if oil was at $80 a barrel and we weren't in a pandemic, now are doing the opposite. They buy down. And many neighborhoods, and I take the Heights for an example, instead of going to Westview and Bel Air and paying $2 million, maybe you come here and pay 1.35 million. I still think that's a lot of money, but I think you see that phenomenon a lot. Just the general movement down into neighborhoods that are more walkable, that are greener, that have access to hike and bike trails, that have yards. I mean, even a front porch. If you're going to visit with your neighbors at socially distanced, it's easier sometimes in areas like Montrose, the Heights, near North Side, some of those areas where you just have a character of a home that's more conducive to interacting with your neighbors. If you go to the real numbers, these are October's numbers. Like I say, they're just barely coming out. I'm not sure that they've been made public or whatever, but here's the headline. Sold 9,200 homes, which is a 29% increase over last year. Not only are you selling more homes, and people are downsizing, so we're buying less expensive houses on average than we would have, the dollar volume is up 45% over October of 2019. That's remarkable. I mean, that we're not talking about 3% increase. We're talking about 29% increase in the number of sales, 45% increase in the dollar volume of those sales, average price going up by 12%, median price going up by 12%. And it's basically every indicator that you would have basically expected. Of course, multifamily is going to be down because that's higher density of people living in closer contact. So it would be natural that those sort of things, condominium rentals, you would imagine would be down, high-rise rentals, because you can't get into many of the condominiums, Greenway 14, Greenway 15, Georgetti, especially if they were older. You couldn't even, they didn't allow showings of real estate agents for many months there. If you can't show the units, you can't rent them or you can't sell them. And of course, those were just health precautions that they felt necessary to take on behalf of their own residents. It was a natural phenomenon. I do think it's interesting, the lot sales that were up, and I think it's the same economic scenario when I look at it. People who had a lot that would have gone through the 2 or 3 year ordeal of designing a house and building a house, probably dealing with cost overruns, are more interested in just selling the lot and moving on and buying the existing house, probably one cheaper than what they would have designed. So we've put on a fair number of lots, which is good. Except the demand for people who want an oversized lot or a different lot has been phenomenal. The bidding wars, I mean, if I put on a normal lot in the Heights, I know I'm going to have 10 offers, and it's just a function of which one is cash, which one is the most conducive to what the seller might be wanting to have, a lease back period, or not subject to financing, or whatever the scenario might be. But all of these sort of October numbers significantly. If you look at every scenario, basically that's driven by the fact that you only have 18,000 single family listings today. And like I said, we could look at any scenario, but almost all of them are down relatively significantly. if you look at the year to date, so that was October compared to last October, let's compare, January 1 through October 31 of 20 to 19, same thing, remarkable. Year to date, up over 8% in the number of sales, dollar volume up 13%, average price up 4%, median price up 6%, same sort of scenario happening, which is, this is the 5th month in a row of increased sales over last year. And that phenomenon was basically, pause in March and April, which was really not very long for our essential service in real estate. And then you push those numbers. So it was fairly expected that you would be up in, June, July, and August, because that's really the March, April, May selling season being pushed over. To be able to be as resilient as we are, 5 continual months of roller coaster of national headlines and pandemic euphoria, it's pretty amazing that you would be up this far at this point of the year of, like I say, compared to what was a significant year last year. Look at the rolling 3-year average of things. I mean, you can tell that the trend for November is going to be virtually about the same. I don't know that it can be up 30%, but you have enough pending sales already compared to last year that you're going to see sales go up pretty well. Normally, you sell a few less houses in November. Remember, there's a holiday break in there of about a week that people don't want to show their house, or the realtors are gone on something or whatever. And then you bump back up and have a very good December. I believe that you're going to see, increased number of sales in November over last November, and December, you start to maybe close the gap a little bit, but I expect it to probably still be a very good November and December. And you can look at these numbers every January and every February. They're always off 40, 45% compared to October, November, and December. It's just cold, wet, and rainy. Every incentive for homestead exemption, the number of people who are moving in the middle of the school year, the number of people that start a job January 1. You can imagine why the houses, sell more in December, and then there's a drop off in January and February, and then you come into what is the spring selling season. It's easier to sell a house when it's 72 degrees than when it's 42 degrees and cold and wet and raining. But the story here, again, is the amount of inventory. You compare last October, where you had 27,000 houses for sale and you only have 18,000, you don't anticipate the inventory. If the inventory last January was 24,000, it ain't going to remotely be close to 24,000 after you sell 7,000, 8,000 houses in November and December, and you're not replenishing the stock significantly enough. And I want more inventory. We started this year talking about supply and demand and what the impact of oil was going to have on that sort of thing. And you wouldn't want a scenario where we had mass exodus out of the city or county. More houses are being listed and there's not enough buyers. That's softening. No one wants to buy IBM stock for $40 if they think they can get it for $30. Nobody wants to buy a house for $500,000 if they think they can get it for $450. And that's just a function of supply and demand. And so I think between interest rates remaining low through 2021, no scenario that people think that it's going to, rise significantly during that particular time, and the fact that you'll have a relatively balanced market in Harris County, not saying the nationwide it's going to be the same, that it's going to be, pretty good time for both buyers and sellers. If we look at this,
Bill, I think we have a question. We have someone virtually raising their hand.
Sure.
Maria, you can talk now if you have a question.
Or I can take them at the end.
Okay. Yeah, Maria, if you had a question, you can also put it in the chat, or
put it in the chat, and then Francis will read it to me or whatever.
Okay.
But I look at these are October numbers for, area 9 is the Greater Heights area. We're going to get even, more defined after that. But, area 9, here's a typical scenario. You sold 381 houses this October versus 2019 when you sold 273. The number of active listings is down in 2020 compared to 2019. So you have less houses than you had a year ago, and you have 385 pending right this second, what would be November 1, compared to 247. So your days on the market is going to be reduced, and you can see it was reduced compared to a year ago. So you have fewer houses than a year ago, more pending than a year ago, significantly. I mean, I'm not a mathematician, but that's at least 33% increase or something of pending sales, with inventory off about 10% or something. So this is projecting that November will probably be pretty good again compared to whatever the November of 2019 was. Montrose, here's the same basic scenario. You sold 20% more houses. You have less inventory than you had a year ago. You have 25% more pendings. You're doing fine over here in Montrose. In area 17, West U and Bel Air, these sort of things, same thing. You sold 33% more houses. You got fewer houses coming on the market. You got fewer houses than you had a year ago listed. You have 45% increase of pending. I mean, there's hardly a scenario that gets much better than this in real estate, unless you're a buyer and you want to wait it out. And I've heard this scenario for 22 years. I still remember the number of people that wouldn't pay $200,000 for a bungalow because they were waiting for those bungalows to go down, that are now $575,000. There's barely a good time that means waiting that doesn't cost the consumer more money. There's no indication in my world. There may be less competition, so maybe there's no bidding war, but I have no indication that the value of single family homes, in good neighborhoods will do anything but continue to maintain its value or go up. It's just basic supply and demand. It's the same thing. It becomes, these inner city neighborhoods become more desirable to live in, not less desirable to live in. So of course, all of these scenarios are really focused on being more what we call hyper local. So even area 9 is a huge area, and you can't compare your house to area 9. You've got to get closer in than that. So what we try and do is, you got to get with your real estate agent. You really need to care about 1 mile from your house. But here I'm just done a little scenario of greater heights of single family homes, but not getting to the edge, not popping over to Airline, not popping to Shady Acres, just the basic general heights area. How is it doing in particular price points? So you look 500,000 and under, and 500 is a tough price point to begin with. But if you just look at this is October's scenario of what happened in that geography under 500,000, which is probably going to be an unremodeled bungalow, or older bungalow, or a subdivided row house or something of that nature. So we sold 19 in October, and you have 44 for sale today, but you've got basically another 21, 22 pending or whatever. So if you're pending 19 to 22, and you only have 44 to choose from, that's about 2 months of inventory. Remember, a balanced market is 6 months of inventory, although I think probably 4 or 5 is probably a healthier number for the areas that we show and sell in. So that market, as you would imagine, is doing quite well. And we recovered first in that price point because it was just a cheaper price point altogether. I'm having a little, so if we go to the next one, which is 500 to 800,000, same thing. You sold 53 of those homes in that geography. You have 113 for sale today, but you've got statistically about the same number, 35, 45, 52 pending. So you're selling about 52 out of 113. Same thing, about 2 months of inventory any way that you look at it in the 500 to 800,000 price point. Here's 800 to 1.25 million. Same thing, 51 for sale. You sold 18. Last month, you've got 29 pending with 51 out there. Same things. Look like you're pending or selling about half of the inventory that's active, for this month, even in this price point, 800 to 2.5, which is still a very tough price point to get into in that geography that you're in. Things do get a little softer, and selling and listing a number of houses above 1.25 million. You know, I'm well aware of what's happening here. So we only sold 6 in October, but what you have is basically 13, 14 under contract today out of 38. I will tell you, this is a little deceiving, but you know, you have $3.5 million projects on Yale or $3 million listings like my 540 Heights Boulevard, which are really commercial. You could take out about 8 or 10 of these, which really just want to be commercial structures, but I didn't limit it 1.25 to 1.99. I just grouped them all together to say it is softer in that market. Really, the comfort level has been 1.25, 1.35 has performed very well, even the last 5 months. The higher price point is just now coming around. I mean, it's just been the last month or two where people have been a little more comfortable, you know, recognizing that, you know, we can buy a house and it still be okay there. But the thing to show here is that you're doing better for November than you did for October. The headline is just coming out later today or tomorrow or Thursday, which is going to talk about this 30% increase and 40% increase with a 30% decline. It's going to instill a little more confidence in the marketplace. So in many ways, it hasn't been great, above 1.4 million, 1.5 million. I mean, I'm well aware of it, but it's better than it's ever been. Okay. So 2 examples I would share with you. 1109 Oxford, I'm selling, you know, in this price range. I've had on the market 342 days. Okay, it's taken longer to sell $1.6 million houses. I recognize that it has. We've done a few things, but it's out of the option period. Financing is done. We're closing November 30th. Yesterday, I got under contract for 1618 Arlington. Same thing. I've had it 255 days. And then ended up with multiple people have interested because I think they just looked up right after the election, got more serious about buying a house and decided this was the best value house with a 5-bedroom master down in the middle of a great street. So houses that have been on for an extended period of time, which I know are somewhat frustrating, you know, it doesn't mean they will sell. And sometimes we're gonna have to reposition them. We're gonna have to take them off, re-enter, shuffle the photos, you know, but it's these headlines that are gonna give people, if the headline was up 2%, it would not be the same as you're talking about 30% increase, talking about year-to-date increases of 8%. You're instilling some confidence into the marketplace more than ever before. And like I say, the most important thing for your home, if you're watching, or you know, whatever real estate agent, you really do have to be hyper local. You've got to figure out, instead of, you know, I have a very nice house in Briar Grove, and in 2.3 million. No house in 1 mile of that has sold since March. I mean, it just, you know, we had one that was new construction that got under contract before it was started. That one's closed. But it's not like, and we've had showings, but I haven't lost any buyers. No one, and my seller, you know, an energy trader sort of guy, look, it's a commodity. If no one's buying that commodity, we didn't lose a buyer. There, you know, you just have to stay into the marketplace. It won't sell if it's not for sale. We just have to, that price point in that particular neighborhood has been high, and it's going to take, you're going to sell the $1.5 million first, then you're going to sell the 1.79 million, and you're going to get to where there's some confidence level, because there's about 10 of those houses at 2.2 to 2.4 million dollars. They will sell. We just need a little confidence. I don't know how to get more confident other than saying sales are up 30%, inventory continues to decline. So that's a factor in those decisions. I do think people want to know, well, what about the election? And we've talked about, you know, just in general, people don't like the uncertainty of elections, whether that's Bush Gore, or whether that's Clinton Bush, or whether that's Obama Bush, or whether that's Clinton Trump, or it doesn't matter, because the pendulum tends to shift every 4 to 8 years anyway. The period leading up to elections is uncertain in the stock market. It's uncertain in business, and certainly uncertain in high-end housing as well. I think for what the market is saying, this is probably what has happened, the best scenario. Different president with a check and balance of a Senate that keeps things in perspective. And so people in Realty, Americans love divided government. It's called checks and balance. It's the reason it's there is to keep those three branches, to keep each other in check. And it will keep extremist policies probably from taking place, which will probably be good for oil, it's good for the climate, good for real estate, a little more stable environment in many ways. And I'm not a policy person, and I'm certainly, of course, not trying to offend anyone. I'm just telling you what is the media saying, what is the marketplace saying. Every real estate stock, Realty, Coldwell Bankers, Zillow, Redfin, all have performed exceptionally well after the election, as have many other industries, because A, the damn thing's over, and B, it's not so one-sided, and the balance is, like I say, may not be great for everyone, but it keeps you from falling off of a lot of edges. So I'm just saying the marketplace is saying that what happened in the election is probably, it certainly isn't detrimental for housing. And I don't think it's a windfall for housing. I think it's moderate policies that will be debated along the way, and it'll probably be just fine for housing overall. One of the phenomenons that I think we're having to pay attention to, and especially if you're going to be, a moderately higher price point, we know that the consumer likes new construction. It's shiny and new, and health perception is easier. They want new construction when they can get it. It's like a new BMW versus a 10-year-old Lexus. I mean, given your choice, if the price is similar, you'll choose the new one. Housing stocks are a little bit different because of location, but no one really wanted a project. If you're buying a house today, you had money and not time. And so if you didn't have the same amount of money, you remodeled because that was your best option. You probably didn't really want to remodel, but that was your only option. Moving was not really probably in your cards. But what we're seeing is dramatic increases, like say in that land that I showed earlier. The price of dirt is going up relatively significantly, and the price of the goods, the shortage of production and shortage of manufacturing, the impact on the international arena, for materials that would typically have come from overseas. You're seeing that disruption of their production, of the shipping, of the delays to get it here. So you're seeing 14 and 15% increase in building materials almost every month, so that some projects are costing 30% more, 40% more for certain goods, whether that's lumber, whether that's sheetrock, whether that's OSB, whether that's a cooler faucet. And I don't think that production is going to kick in significantly also. So the sheer cost, so you're a buyer, we're thinking about buying a modern bungalow house for $1,350,000, but wanted to wait for something. I don't know that the interest rates get any better. So you can get a jumbo loan today. We have clients buying 523 Harvard. $1.1 million is what they're financing at 2.75% interest. That's pretty good for a jumbo loan. But I'm afraid that the cost of that house, let's say you didn't buy it today, if the cost goes up by 100,000 and the interest rate goes up by 0.5%, you can see where the cost of that house is significantly greater 9 months to a year from now. So I know it's somewhat frustrating. Is this a good time to buy? I'll wait it out. I'll wait till it gets cheaper. Well, I don't know that it's going to get any cheaper. If you want a house, the cost of the house or the remodeled house or the house that's had updates is going to cost more, because those updates cost more. Try and call you a remodeler for an addition for a new master bedroom, bath, and den to your home inside the loop. They're happy to talk to you and put you on a schedule for 2022. You're not going to find someone who's going to be able to do these projects anytime quickly. And not only is the construction cost up, and almost every day you see the number of skilled laborers in each of these industries is off in Houston, Texas, and Texas in general by about 20-25%. So fewer workers, which means higher cost of workers that are here, higher cost of materials, higher cost of land, can certainly increase the cost of housing over time. So, in the basic summary, the market is very strong compared to a year ago, stronger than we would have thought. The projection, I believe, is that it will remain strong for 2020. The numbers and the headlines should be up pretty well. I'm overly concerned that the headlines will not be as great in 2020. And it's the sheer fact of you do not have enough inventory. You can't, it's unsustainable to think that you could sell 10,000 houses if we don't increase the amount of inventory. And I don't see the impediments for we can't build enough to increase the supply, and the number of new construction, even in these numbers, is relatively insignificant, 10 or 15% in any category. So it's existing home sales that you have to worry about. I think there's going to be further economic concerns. I think the winter, we might enter into a dark winter, which impacts people's morale and things. And then you come out of the springtime and are a little more hopeful with vaccines, end of winter, end of COVID impact, opening back up of economies, both internationally and nationally, as well as locally. Not that I think we're going into any major lockdown. I don't think we can handle that emotionally or economically, but I think there's just going to be a roller coaster a little bit about some long-term deals, which will just impact the demand and the supply, and they'll stay relatively balanced. But I do believe the demand to live in Houston, Texas, in a single family house or a townhouse with a yard or a balcony or room to work from home, there's going to be some changing dynamics that still impact 2021. And then, any projection beyond that would just, be a guess at this game or whatever. But overall, these places remain amazing places to live, work, and play. Those that can sell and move to Round Top or the country and work, well, that's more power to you, because that's a nice gig if you can get it. Most of us just can't afford that gig at the moment. So market strong, continued strong through the end of the year. Continued lower interest rates, which will fuel, the demand, especially in these lower price points where people can afford. I look at the rental market, having 27, 28-year-old kids paying pretty high rent. I think you can, at 2.75, go buy you any house. It may be 10 miles out. My kids can't afford to buy in the Heights. That it's not 135,000 anymore, but you got to find the up and coming next 135,000 or $200,000 or $279,000 place to go buy a home and put in a little equity and improve those neighborhoods as well. So overall, a very positive market. The key is to continually look at your micro or hyper local market and adjust accordingly. If you're in the higher price point, don't lose faith. Do continue to, keep up your, the cleaning and the painting and the new photography and the new ability to show the house to people as they hear and read these headlines and have more confidence into the marketplace. So I hope that was informative. If there are any questions, I don't know.
Francis? Yes, we do have one question for you, Bill.
Okay.
Jessica Green is asking if she should sell now or sell in spring of 2021. She's on the fence.
I have a number of people that ask that question, and I will tell you, I have no indication that the spring will not be equally as good, if not better. Just the fact that you're further into COVID relief, you're further into, just what is, a very perilous time. I had a number of people ask that question, and, if they were so motivated, a lot of it depends on where you're going and what you're buying. Like say, if you wait 4 months to sell, but what you want cost 5% more than what you sold, there was no reason not to go ahead and sell now. But I had a number of people that just look, between the timing and Thanksgiving and Christmas and just now getting back to the office, I recommended to them just wait till March. There's no scenario that really unforeseen scenario that the price per square foot wouldn't continue to increase. There's not going to be a significant increase of supply. And if it's just as comfortable for you. My 21-22 Albans is a perfect example. New job, started last week in Columbus, Ohio. Can sell now because the kids can move during the middle of the year, but they weren't going to move, if it wasn't just really over the Christmas break. And we literally were listing for 14 days and going to sell, and they were moving December 20th, or we were just going to wait and put it on March 15th and sell and stay till May 31st and move the kids. And either scenario was fair to them. He was working in Columbus. He wasn't going to go to the office. He was going to work from the living room anyway. We just decided to try, and had multiple offers and ended up with one that was cash that closed quickly, that wasn't subject to financing, no real option period, that gave them 21 days basically to rent back for $700. That scenario, they decided, let's just go ahead and go. But I'm equally convinced if we had listed that house March 15th, the same scenario would have happened. So for them, it was just a question, do you want to go now or do you want to go later? And they were risk averse and they would rather just take their money now as opposed to waiting for something that could go wrong. There's always fears that things could go wrong. But I have, and I have many people, I mean, I just, like I said, I went on a listing appointment and we looked at their scenario and you know what, it's going to be really better for their lifestyle just to wait until the middle of March. And no reason not to do that. I mean, I'm in the game of real estate, and so we'd rather sell now than later, but there is no indication that it won't be calmer, better, just as easy to sell your home in March or the spring of 2021. So I think that those are just personal decisions. From the financial real estate perspective, I consider it to be a total wash, just as good today and just as good in the spring. Not January 1. There's not as many sales in January or February. You don't want to be on the market for 60 days when the real buying season kicks in the middle of March. So I tell people, you know, if maybe you want to buy in January, February houses that were overpriced in September, October, and November, because the sellers are going to get to be way more negotiable in that period of time. But if I were a seller, and Valley Forge and Briargrove, it's the same thing. We're going to stay on till the 20th of November, and then we're taking off the house and we'll put it on again. You know, I have an expensive house in the Heights. We're going to stay on till November 15th, about a 30-day window, and then we're going to take it off and put it on in the spring. Not going to let the houses sit there forever. And in both of those scenarios, where they're going isn't going to be ready till the late spring anyway. So it was just kind of a test, but they don't mind waiting to sell in the spring, and maybe it'll be better for those particular markets in the spring, or just that much further along into some form of economic recovery and, you know, past election and inauguration and, you know, just distractions. So I think it's just as easy, and the market will be just as strong, if not stronger, in March of 2021. If you're the buyer, I think prices don't go down, except maybe in January and February, where people are a little more negotiable and there's less competition, not necessarily cheaper, but less competition at buying a home. But it gets pretty darn competitive if you start to go buy one March, April, May of 2021. So I would just buy now before I bought later. If I was a seller, whatever, it's kind of dependent on where you're going and what you're buying. I hope that answered that question. Any other questions, Francis?
That is it.
Okay, thank you all. Remember, this will be available on our website, or your agent can email it to you if you can't find it, or just reach out. We'll make sure that you get it, and we'll do it again publicly when we have enough information. You know, we were saying every 2 weeks, but sometimes there's just not. It's ditto, 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 ditto. And so I don't want to just talk for the sake of talking. I wanted to really lay out, there's going to be some pretty significant headlines that are going to instill more confidence into the marketplace. And that's really why we did this one today. And we'll wait 2 or 3 weeks and do it again. And then again, right at the 1st of December. So thank you all for being here. Hope you had a great day and a great time, and look forward to visiting with you all soon. Bye-bye.